What is depth of the market? DOM. Depth of the market, DOM, is a measure of supply and demand for liquid tradable assets. It is based on the number of open buy and sell orders for a given asset, such as a stock or futures contract. The greater the quantity of those orders, the deeper or more liquid the market is considered to be. Depth of the market data is also known as the order book, since it consists of a list of pending orders for a security or currency. The data in the book is used to determine which transactions can be processed. DOM data is available from most online brokers for free for a small fee. Understanding DOM. By measuring real-time supply and demand, market depth is used by traders to access the likely direction of the asset's price. It's also used to gauge the number of shares of assets that can be bought without causing its price to appreciate. If a stock is extremely liquid, it has a large number of both buyers and sellers. A buyer can purchase a large block of shares without causing a substantial stock price movement. However, if a stock is not particularly liquid, it doesn't trade as consistently. Purchasing a block of shares may have noticeable impact on the stock's price. Depth of the market is typically displayed as an electronic list of outstanding buy and sell orders, organized by price level and updated in real time to reflect current activity. A matching engine pairs up compatible trades for completion. Most online brokers offer such form of DOM display. This allows users to see a full list of buy and sell orders pending executions, along with the size of the trade, rather than the best options available. How the market depth works. Market depths typically can be found on a trading software or brokerage websites. For all but most of the thinly traded stocks, it is a snapshot of the current bid and ask positions of the stock. When a large order to buy or sell a stock is made, it can affect the market with mechanisms discussed above. By taking all the available shares at a various bid-ask level, there is also an argument that the market depth is affected by the asymmetry of information. That is, market assumes that the people making large orders have more or better information than the people making small orders. So if a large buy order is put in, smaller trades will race to join in, assuming there's something they don't know. Liquidity providers also affect market depth. If there's a lack of liquidity, then the stock institutions may not want to take a full order, requiring the trader to use multiple institutions to move in and out of a large position. If the orders are biased in one direction, that can signal in which direction the stock price will move. For example, if 60% of the orders are to buy and only 40% are to sell, the price will likely go due to that buying pressure. Additionally, traders can look for the point when sell orders start to overtake buy orders to find levels of resistance, and when buy orders start to overtake sell orders for levels of support, it is likely the stock will remain within the support resistance bands until something substantive changes. How to use DOM data. Depth of market data helps traders see when the price of a security may be heading in the near future as orders are filled, updated, or canceled. A trader might use market depth data to understand the bid-ask spread for a stock along with its current volume. Stocks with a strong depth of market tend to be popular. Large cap companies like Apple, they usually have strong volumes and are quite liquid, allowing traders to place large orders without significantly affecting their market prices. Securities with poor depth of market tend to be more obscure companies with smaller market capitalizations. The prices of their stocks are likely to move if a single trader places a large buy or sell order. Being able to view the depth of the market information from a particular security in real time allows traders to profit from short-term price volatility. For example, when a company launches its initial public offering, traders can watch its DOM in real time, waiting for the opportunity to buy or sell shares when the price reaches the right level of demand. Examples of DOM. Say a trader is tracking DOM of stock A. Their shares might currently be trading at $1, but there are 250 orders at 1.05, 250 at 1.8, and 125 at 1.10, and 100 at 1.12. Meanwhile, there are 50 offers at 0.98, 40 offers at 0.95, and 10 at each at 0.93 and 92. Seeing this trend, the traders might determine that stock is going higher. Armed with that knowledge, the trader can decide whether it's the right time to jump in and buy or sell the stock. Key takeaways. Depth of the market DOM is an indicator of the current interest in a stock or other asset. It can be read as a signal of the likely direction of a stock's price. It is used to judge the optimal time to buy or sell an asset. So for the indicator, depth of the market, the DOM, study it, analyze it, adapt it. Peace.